Hello, chart watchers, and welcome to this Thursday, August 15th, 2019 Market Watchers live show with your hosts, Tom Bowley and Julius de Kempenaer. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Taking a look at today's action, not really much of a bounce after yesterday. We are higher. Dow Jones Industrial Average currently up 72 points, the S&P 500 up 9, the NASDAQ up 5, nearly 6. But the Russell 2000 lagging again, down 3 points today. 10-year Treasury yield continues to move lower. Money continues rotating into Treasuries. The yield down another 4 basis points today, 1.54%. Volatility index was up earlier today, challenging the high that we saw a couple of weeks ago. It has backed off, though, now down about 3% on the day. One thing I'm taking not too much comfort in is the fact that we are being led today on this attempted rebound by defensive sectors. Consumer staples, real estate, utilities, 3 best groups today. That's not good. Energy to the downside sliding again. Technology also moving lower. We don't want to see technology down near the bottom of the leaderboard on an up day. Broadline retailers getting a little bit of a lift today, but still in an overall downtrend. Clothing and accessories just really accelerating its slide to the downside. Couple of stocks out with their earnings heading in different directions. Cisco warned going forward. They're down now about 7%, down almost $4 today. And Alibaba actually came out with a really strong report, beating its estimates by a wide margin, gapped up nicely, and is pulled back since that open, but still up a few dollars, doing pretty well on the session. All right, I do want to mention for everyone again, I mentioned this yesterday, but StockCharts president Chip Anderson will be rolling out a new show on Saturdays. It's called All Aboard StockCharts. He'll be showing you all the best ways to use the new ACP charts. He'll provide great ways to use the StockCharts.com tools in general. It will air for 1 hour every Saturday at 1 p.m. Eastern. Again, All Aboard StockCharts begins this Saturday, August 17th at 1 p.m. Eastern Standard Time. Make sure you tune in. If for some reason you can't make it, there will be replays. There will be replays later that day on Saturday and throughout the week. But just keep in mind, All Aboard StockCharts begins this Saturday, August 17th. All right, Mr. de Kempenaer, it's great to have you in here subbing for my normal co-host, Aaron.
Thank you very much, Tom. Yeah, I'm good. Some big shoes to fill again, but I'm getting used to it. So looking forward to the show, man.
Yeah, it's always good to have you on here, and I'm sure just about everybody knows, but you are the founder and creator of the RRG charts, and we're going to be doing a lot today with the RRG, so I think it'll be a great show for everybody, so you definitely want to check that out. I don't know. I kind of want to spill the beans, but I don't want to spill the beans as far as what we're going to talk about. What do you think?
You can spill a little bit of beans.
All right.
I'm just maybe a little teaser so people stay here and they don't walk away on us.
I'm going to let out one RRG bean and just say that, these trade wars obviously created a lot of problems for the market back in the fourth quarter of 2018, again in late April into May of 2019, and now again, the trade wars maybe combined a little bit with the Fed as well. And maybe you have some other things in there that maybe it's the inverted yield curve that bothers you, but there's a lot of things going on. But we're going to use the RRG to kind of dissect a little bit of those declines. And I think visually, I think it'll really help to show what's going on there. So there's your tease. So you want to make sure you stick around.
Absolutely.
Here is our upcoming schedule. As you can see on your screen, Julius is back again with us tomorrow. So this will be really cool. Fridays, of course, we do What's Hot, What's Not. So Julius will join me for that segment and the rest of the show. Next Tuesday, Aaron's going to be doing a workshop. And then next Wednesday, Danielle Shea returns. We always have a lot of fun with Danielle on the show. So looking forward to that. Today's agenda, dissecting the trade war with RRG. I think that's going to be a really fun segment. So stick around. We'll get into that in about 10 minutes. Our first 10 in 10 stock today will be Procter & Gamble. More defensive stock. We're just talking about some of the defensive stocks leading today. So we'll take a look at Procter & Gamble. And then, of course, we will wrap up the show after that. So we don't have a whole lot going on. But I tell you what, that segment, the Dissecting the Trade War segment, is going to be awesome. So you want to stick around for that. All right. I tell you what, I don't think I've ever seen this many economic reports out in one day, but there they are on the screen. If you can read them all, congratulations. I just want to say overall, I think most of the reports came in pretty good. You can see initial jobless claims was a little weaker than expected, but Philadelphia Fed survey, retail sales, both very strong. Empire State Manufacturing survey, better than expected. Productivity was good. If there was maybe a little bit of a weak link, it was in the industrial production and capacity utilization reports, where we saw a little weakness there that may be worth watching given that yield curve inversion. But otherwise, I think the economic reports were pretty good. As far as the reaction, though, in the bond market, it's pretty much the same, just a lot of buying of bonds. And you can see that the movement to the downside here, very, very strong and continuing. I mean, this started really when the Fed came out on that Wednesday afternoon, their policy statement. They said they were lowering by a quarter. I think the market was disappointed that it didn't get 50. I think it was really disappointed that the Fed didn't go out on another limb and say, we see more coming. Instead, they said, well, we'll just kind of sit back and watch. Market didn't like it, and I think they're sending Jay Powell a pretty big message right now in terms of that yield ever since that meeting, down from about 2.06% now to 1.54%, and that comes in about 3 weeks. I mean, that is just a crazy drop there. Earnings reports, we're still getting some big ones coming out, and I'll tell you, the ones you see on your screen there, Alibaba, big report. Cisco looks pretty good on the surface, beat on the bottom line, but that was not a good report they came out with. We talked about Cisco a little bit in the poll yesterday about, neither one of the companies looked very good in terms of their upcoming earnings and the way they were trading on their charts. Of course, Cisco and Network Appliance. But Cisco, you can see, did beat. Reaction not good, though. We'll pull that chart up in just a moment. And then you can see some others on the screen there. Network Appliance actually had already lowered their guidance. So part of it was they had already warned, and they came in and they actually beat that lowered guidance. So their reaction was a little bit better today. But let's go ahead and start and take a look first at Cisco. This is a earnings report that came in, like I said, not exactly what the market wanted to see, and it was already starting to show some warning signs, I think, when you look at the chart. But Cisco beat on their top line, beat on their bottom line. So if you're just looking in the rearview mirror, everything's fine. But apparently Wall Street was already beginning to get a little bit of a sniff that upcoming quarter was not going to be good, because Cisco guided their Q1 revenues and earnings per share lower. And if you look at the relative strength, and this is what we pointed out on the show yesterday, first of all, telecom equipment stocks had really been taking a hit over the last month, as you can see. That's the absolute chart. Then you had Cisco relative to its telecom equipment peers already breaking to about a 4 or 5 month low before it came out with its earnings report. Relative to the S&P, same thing, 5 month relative low. And then look at telecom equipment relative to the S&P. They're literally just falling off a cliff here. So you've got Cisco not performing well in a group that's getting crushed by the S&P. And that translated into a not so good report. As you can see, Cisco not good, lowering guidance and so forth. So what can I say? Agilent came out. They did beat top line, beat bottom line, and offered mixed guidance. They lowered their Q4 earnings per share estimate, but they raised their fiscal year 19 earnings per share. So the guidance was raised for next year, or actually for the rest of this year, but the next quarter guided lower, which was kind of strange. But anyway, Agilent gapped up today. It is up about 7%. Still, though, in a downtrend and on a relative downtrend. So, yes, good news in the short term. I still have some issues with this one going further out. Alibaba, talked about this at the open. Another one gapping up, looking pretty good in the short term. But when we look back at the chart, I don't know, maybe a little bit of a triangle forming, rising lows, falling highs. I look at the relative strength, though, and this is a broadline retailer. It's trying to break out versus its peers to about a 3-month high. So we're seeing a little bit of strength here. I would still like to see at least an absolute breakout above that 180 area before I'd start getting more excited about it. You can see on a relative basis, the broadline retailers had actually just set about a 5-month relative low to the S&P 500. So it's not been a group that's been in favor, but Alibaba came through with pretty good numbers. So again, I'd probably just go with maybe a mixed bag there. Network Appliance. And yesterday at the poll, I thought about this morning when I saw the reaction. I probably should have gone with the minority yesterday. The question was, with Cisco and Network Appliance, which one, I don't remember what the exact wording was, but essentially which one would have the worst report, and or actually which one would have the better report. And I think 85% said Cisco. And I kind of went along, said the same thing, but I had forgotten that they had already warned and already taken a hit for that. So this is actually maybe a little bit more, I guess I could see the reasoning for this move back to the upside, given the fact that the company had already warned. But they had actually warned just 2 weeks ago and said their earnings would be between 55 and 60 cents per share. And they came in at 65. I don't know how you missed that much. I don't know whether that was intentional to actually go a little lower than expected and what they really truly believed they were going to have just to make sure they covered everything. Maybe they still didn't know at that point. They had to figure, I don't know, being a CPA, that just kind of bothered me that at the beginning of August, 65 or 55 to 60 cents per share. There's a lot of shares outstanding for Network Appliance. I didn't go back and look at what the amount was, probably in millions, but it just seemed like they were way off. I don't know, maybe a little counting issue going on there. Anyway, Walmart, let's pull this one up. Walmart, you can see, actually did come in with some pretty good numbers. They actually guided higher. They guided their fiscal year 20 earnings per share higher, in addition to beating top line and beating bottom line. And when you take a look, the stock really had been, maybe just kind of going sideways amongst its peers, had been in a little bit of an uptrend, I guess, pulled back, and then with earnings trying to make another breakout here on a relative basis. If they continue to strengthen into the close, though, this would be about a 6-7 month relative high versus its peers. And you can see its peers have been strong. So that's enabling Walmart to actually break out versus the S&P 500. And with solid guidance, I think this is a pretty decent stock to consider going forward. I think Walmart looks pretty good. TPR, this is a classic lesson in following relative strength and also following the group that you're investing in. Clothing and accessories have been horrible. They continue to be. They were really bad today. They've been bad. They're bad throughout the trade war that we saw back in the fourth quarter. April and May, they were bad when the trade war came up, and again, taking another big hit. And Tapestry, TPR, has been one of the worst stocks within this space. So am I shocked they missed their revenue, matched estimates, and then lowered guidance for the next quarter and the next year? No, I am not. I think Wall Street saw it coming. They knew it. And today we get the news. That's why it's so important to follow relative strength. All right. Taking a look. First, let's go in and let's take a look at the dashboard here, because one of the stocks, hopefully it's on the list. Actually, oh, there it is, Sienna. So among the mid caps, it's one of the biggest one of the biggest scooter movers to the downside, those that are falling. And I want to just show you the chart here, because like Cisco, Sienna is in that telecom equipment group, and it's moving lower. The relative strength is horrible. And I think we've really got to watch Sienna here, because this is a major area of support. Since the big gap up in June, we've been holding in this 40 to 41 area, and today we're testing it. I'd be careful if Sienna closes below 40. I think given everything going on around it, I think this is a big, even though maybe the scooter mover is only 11 points, I think it is pointing us to a stock that could have some difficulty going forward. So for that reason, it is my scooter mover of the day.
Yeah, very good, Tom. So now it's time for the upgrades and downgrades. And I will take the screen for that, because I will bring in the RRGs. So what I've done is I have filled up 2 RRGs, one with upgrades and one with downgrades. And the RRG that you see on the left right now is the one that is filled with the upgrades. And I'm going to just pick and choose a few of those stocks to go over. The one that you may think is super interesting to look at is GCAP. I looked at that before the show, and I wasn't super happy about it, and it's not a super convincing play. these are upgrades. And the one that stood out for me that I want to talk to you about is PLCE, the Children's Place. I've got the chart of PLCE on the right. And remind you, this is an upgrade. And what I see is a stock that's breaking down and that's losing relative strength and that is starting to push deeper into the lagging quadrant. So I do not agree with that upgrade. The second stock on this universe is JB and we'll find that on the far right of that RRG. It's the highest ranked stock on this universe, and it is just turning around. If we zoom in, we can see that GB is just turning around, and we know that that is a very good sign, especially when it happens so far to the right. And if we bring up that stock right here, JBSAY, you'll see why I like that. It's, you know, this is a super strong stock. We've had all these moves in the market going up and down, and this one doesn't care what the market is doing. It's going up, super strong uptrend, high relative strength, high RS ratio, relative strength kicking higher. So I really do agree with this stock being an upgrade. So that's it for the upgrades here. Now, the downgrades is a different story. Well, let me bring that up. By the way, you can see that I have saved these RRGs. And the way you do that is you can type in the ticker symbols here in that symbols box, hit update, and it will give you the RRG that you want. And if you want to save that, you simply hit the permalink button at the bottom, and then save it as a bookmark in your browser. And when you go back and you, just like I did, these are bookmarks here. This one is for the downgrades. You click it and it loads up the RRG as you have saved it. Anyway, these are a number of downgrades. Now, one that I really, really agree with as a downgrade is Paychex. Look at that. It's inside the weakening quadrant, but it's starting to move towards lagging, and it just seems a matter of time before it will enter there. And if we look at that chart, then you'll see why. It has had a nice run. It had strong relative strength, but it's losing. It's rolling over right now. And look at this RS ratio coming down. RS momentum is already below there, below 100. And it is just about to break down here below this previous low. And that's a very nice sell signal. Be careful. It's a weekly chart. So there is still the possibility that it will close back above that low. But the initial signs are not very good. So I'll be on the show tomorrow so we can go back and have a second chance to look at this. But for now, I do agree with this as a downgrade. The other one that I want to look at is HST. That's inside the lagging quadrant. And if we look at that on the chart, then you'll see that this is dipping on relative strength, RS ratio moving down deeper into the lagging quadrant, and we're about to break below this support level. We're rapidly approaching it, so that is very, very difficult. I'd be very, very careful with this one. And I have to really speed up here. SAH is on the other side of the universe, and that's actually looking a lot better. SAH. We look at that, and then you'll see that this is a stock that's breaking out of the upside. Look at that relative strength. That's just turned around from a long-term downtrend. RS ratio has picked that up relatively early. So I actually do not agree that this is a downgrade. I think it's a great stock. It looks great. It's got strong relative strength, and it's breaking out in price. The other one that I want to look at you is EVRG. EVRG. Look at that. And that's also a very nice stock. So I do not agree with that one being a downgrade. I love that stock. It's just broke about 60, tested it as support, going to new highs. RS ratio still working its way higher, but it's starting to look good. So for now, these were the upgrades and downgrades. We're going to have a short commercial break, and Tom and I will be back with dissecting trade wars with RRG after this break. See you there.
The ChartWatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the ChartWatchers newsletter.
Okay. And we're...
Whoa, I'm sorry. It's just wanted to welcome everybody back. We're going to head into the dissecting the trade war with RRG in just a minute. But Julius, I know you've got something you wanted to share. You wrote in the "Don't Ignore This Chart" about the about RRG and some of the unique features that people really should be focused on. It's not just looking at the circles and everything and the movement on the chart, but also the length of the tails and some other things. Why don't you just walk everybody through that a little bit before we get into it?
Yeah, Tom, thanks for that. And apologize for jumping ahead of the queue in your intro. It's just too enthusiastic. There's the basic RRG visualization, but since the introduction, we've done a lot of additional research and we came up with what we call derived indicators. And one of these derived indicators is what we call RRG velocity. And I've actually mentioned that in today's DITC blog, which features RRG. I write the DITC every Thursday in normal circumstances. And I was looking at the RRG for the sectors, which is the one that you see on the right here. And let me highlight the financial sector because that's the one that I picked out as being interesting. And why is that interesting? Because it has this nice little feature that caught my eye, and you can see that when we're in that leading quadrant, so in this period here, let me just simply scroll back. This is good. Financials are now at a positive heading. They're getting higher on both axes. But what is at this stage slightly worrisome is that the distance between the day-to-day observations is getting less. It's narrowing. And when these distances, when this velocity is narrowing, there is a bigger chance, or the odds for a turn are increasing. And you see that happens right there. I tried to explain it in the blog as driving a car. If you're going 100 miles an hour, it's very difficult to take a 90-degree turn, or you just overshoot because the speed will just not enable you to make that turn. When you slow down, you can actually make a U-turn very easily, and that's the same with these day-to-day observations. And then when financials start to pick up, you'll see that the velocity, that the distance between these day-to-day observations is increasing, and that is giving you extra comfort, extra additional information about the power behind this move, about the momentum behind this move. And you see that over the last 5-6 days, these distances are much, much bigger than they were just going into this turn. So a little bit of an educational piece there. And Tom, I want to take this opportunity because I now have the screen and I am talking. And there was someone in the chat box apparently asked a question already 2 times. And JJ, this is your 3rd time lucky. He asked, what are the aggressive, neutral, or defensive sectors in the S&P 500? When we talk about offensive, defensive, etc., what are the sectors that we're talking about? The answer is actually hidden on the StockCharts site in plain sight. If you go to the page that shows the perf charts and you scroll all the way down, you will see the sector rotation model. That was devised by a guy named Sam Stovall many years ago, but it's still very, very valid. And you will see the interaction between the economic cycle, that is the blue banner, so it's the blue line here, and the actual market cycle, which is, let's say, the S&P 500, which is the orange line. And the sectors here are the sectors that are doing the best during each part of the cycle. So in your run-up, in your bull market, and these are the aggressive or the offensive sectors, you'll find technology, discretionary, communication services, industrials, materials. And then when it's at a market top and going into a bear market, you will find energy, staples, healthcare, utilities. And then when we move into a recession or at the end of that, you will find financials and real estate. So I find it's not a one-on-one match 100% of the time, but this is how you can get a very good handle on where and when you should look at offensive and defensive sectors. And as a very rough guideline, the left side of this chart is offensive, the right side of this chart is defensive. So I hope that answered that question. Back to trade wars, Tom.
All right. Well, I think what we could do is start, I guess, first with sectors. So I think what we're going to do, I think everyone is aware that, when the market gets very fearful, we did this back in the fourth quarter of 2018, where we took the big drop in the market. Volatility went through the roof, a lot of trade war fears, and maybe blame a little bit on the Fed as well. And then we got into the period in April, late April into May, throughout May, same thing. The headlines became the trade war, the Fed, and now just recently, again, these last couple of weeks, we're seeing again, it's a three-peat of what we've seen at the end of 2018 and earlier in 2019. So what Julius and I decided we would do is talk about the sectors and the industry groups. Julius is going to take the sectors, I'll take the industry groups, and just kind of walk you through these three periods to give you a sense of what works and what doesn't work when the market turns fearful and we turn our attention to the trade wars. So with that lead in, Julius, I'll let you take it away for the sectors. What are you seeing as far as what's been consistent and maybe what's changing throughout these three periods?
Yeah, you got to help me. You got all these dates. I've got my chart on the left is the RRG for the sectors, and you can see the date here. So this is now ending on September 28 of 2018, while the market was at its peak, so to say. And the good feature on StockCharts is that we can actually scroll forward. So what I'm going to do is I'm going to use my arrow keys to move forward and look at these sectors. Right here we see XLV, that's healthcare. XLK is still doing very well. Discretionary is turning up. You see industrials already starting to lose something. At this stage, utilities and real estate are still, and here just behind materials is staples, are inside the lagging quadrant, but they're rolling up, they're leveling off. And then we'll look at the move that takes place when the market starts to roll over. You see, when the market starts to drop, these defensive sectors, especially utilities and staples, are starting to pick up the pace, while the more aggressive sectors like technology and here is materials are starting to deteriorate. So utilities is really pushing it here. That is, where everybody is fleeing to initially, just like staples. So these two you can keep an eye on. When we go into that, let me keep everybody on the screen here, into that decline. And then when the market settles down, you see that utilities is losing a little bit of momentum. Staples is joining it into the leading quadrant, communication services and real estate. That's all defensive stuff moving into the leading quadrant. That's where people are going. You see it rolling over a little bit. Oops, here is utilities off the screen. A little improvement, and then you get it, one of these situations that we talk about a lot. So what are the most sort of reliable, I don't know, I'm not really about talking about signals for RRG, but if you want to see it as a signal, this is a signal when something is inside the weakening quadrant and starts to roll up again. And you see that all these sectors, staples, utilities, real estate, are doing that, while the market is, coming down at this level. And that's sort of a warning signal because these defensives are now really picking up again, and they're confirming their relative uptrend. It's not to say that these sectors go up in price, but they definitely outperform the general market. And that actually continues when you move into that decline, and you see that utilities, real estate, and staples come out on top. And by the way, this is a daily RRG, so this moves much faster than the RRGs than you probably used to, because I usually work with the weeklies. But for this example, we use the dailies. And then when the market bottoms, you see that the defensives, people are starting to rotate out of defensives and go back to the more aggressive stuff like financials and here materials. This is December 28th, so that's very shortly after the bottom. You see that materials is picking up, industrials is picking up, financials is picking up, and all these defensive stuff is getting into the weakening quadrant and lower, and then you'll see that this move starts. So leading into the decline, you see that the defensive sectors are picking up pace, and when the bottom is in place, then they get shifted towards the more aggressive stuff.
All right. Is that good?
I think that's good. I think it helps you with a visualization of where you need to focus your attention. For me, RRG is a piece of the puzzle. It's not going to give you 100% guaranteed ironclad answer, but I think that the fact that you see what's happening in these sectors, and you can see it in one picture, is super helpful, because you will see, if only utilities or only staples was moving, you could say, there is maybe a story behind it. But when you see this whole set of sectors as a group moving in one direction, I think that's kind of a signal that you have there.
Yeah. When I said, is that good? Let me clarify. I wanted to make sure you were good going over the sectors before I took the screen from you.
All right. Yeah. You can do that. Now, take the screen. I'm good, mate.
Yeah. I didn't want to, go.
No. Go ahead.
All right. I want to just show from a sector perspective a little different take. And what I did is I went back and I took 5 sectors that have performed really well this year, and 5 industry groups that have performed really well this year, and then 5 industry groups that have really struggled, and especially when you go through these trade war fears. So let me just show you here on my chart. And, there's a couple of different ways to use the RRGs. And I first of all, Julius, congratulations on establishing this. I mean, creating this. It is absolutely fantastic. Before you came on board, I had no idea about anything RRG, and now I use it quite a bit to help visualize certain things. So first thing I want to do is I want to go back into the last quarter of 2018. And in this quarter, I can start the groups that I have on here. If I scroll down, you can see I've got the defense group, I've got computer hardware, restaurants, heavy construction, renewable energy, clothing and accessories, consumer service, specialized consumer services, waste and disposal, apparel retailers. Now, when you think about these groups, you have to think about their ties to China, because what we're talking about is with the trade wars, which of these groups would you expect are probably going to have a little bit more of direction or a directional clue based on what's going on with China? I think the U.S. defense industry, probably not a whole lot. You look at restaurants and bars, I don't think Starbucks maybe Starbucks a little bit because it's international, but Chipotle, some of these other names, many of these companies do a lot of their business, if not all of it, in the U.S. We look at renewable energy, probably not a whole lot going on there with China, maybe some. Specialized consumer services, probably not much. Waste and disposal services, probably not much. The other 5, though, I think have some pretty significant ties to what's happening in China and what's happening in terms of our trade with China. Apparel retailers, no doubt, as far as I'm concerned. Industrial machinery, no doubt. Heavy construction, computer hardware, I think clothing and accessories, these are all areas that I think are going to be pretty heavily impacted. Now, when you take a look at this entire quarter, and actually let me get them all on there again, and I drag through, you can kind of stop it at any point, but after I get through, this first decline to the downside, this is how each of these industry groups are performing relative to the S&P 500. And if you notice, restaurants over on the right side of the chart, apparel retailers, surprisingly, on the right side of the chart, computer hardware not doing bad. But then you've got a couple of others, the areas that I would expect that would continue to hold up well. And as we work our way through this entire chart, you get to the very end, and the bottom was found on December 26th. And that's really where we hit our panic button. That's where the market just kind of said, we're throwing in the towel, the kitchen sink, everything else. This market has no chance of rebounding. And that's usually when we hit a bottom, and that's what we did. Now, I don't know if you've ever used RRG, but one of the things I think is pretty cool is that I can take a look back. Like right now, what this is doing down here in the bottom, I can sort by percentage change, but it's telling me what's happened over the last 5 trading days, which is based on the tail length that I set. So I can grab this and I can drag it back up to 30 days, which I think is pretty cool because here is where we had most of the decline. Now you look over here on the tails, and okay, yeah, that looks like something I drew back when I was.
It's called spaghetti. I call them spaghetti charts.
Exactly. I think I drew exactly that chart when I was about 3 or 4. But anyway, you can come down here to the bottom though, and you can see what the percentage change was for the 30 trading days ending December 6th, and you can rank it in order. When you look, you'll see renewable energy, and if you click on it, it'll give you the whole RRG trail. And you can see that while the worst selling was taking place, renewable energy actually was hanging out over on the right side of the chart. It was not being impacted. Restaurants and bars were weakening, but we stayed on the right side of the chart. And as you talk a lot about this, Julius, when they turn back up from weakening into leading, that is a really good indication.
And I was thinking about this because that's December 26th. So that's everybody went out for dinner in that period of time.
Yeah, the bars. I think that's where the bars came in. Forget about the restaurant. And then waste and disposal. Again, not really related to what's going on in China. Staying over here on the right side of the chart, turning back up into leading. There's your S&P 500. Specialized consumer services, a little bit on the left-hand side. Definitely was beginning to weaken a bit. And then defense. Defense really didn't pick up until probably around March, April of 2019. But I still don't think there's a whole lot of correlation here with China, just my opinion. But if you look at the ones that there really is correlation to what's going on in China and how everyone perceives the trade war, take a look at clothing and accessories, how it remains on the left side of the chart throughout the entire process, weakening, starting to improve, but still way over on the left side. Oops, I did defense. Here's your industrial machinery. Was pretty good for a while and then completely fell apart, moved over into the lagging. Let's look at apparel retailers. Look at this ride. Just huge move way to the left side of the screen, which means tremendous underperformance on a relative basis. So yes, it was improving in terms of momentum, but it still remained on a relative strength basis over on the left side of the chart, which is not good. Computer hardware, think about Apple. And, they're all the discussions with Apple and what's going on over in China. And then heavy construction. You see the difference? So when the market starts to get fearful, where do you want your money? You want to keep it away from those groups that are getting hit really hard in this trade war. Now, I'm going to go through and show you, and when I get done with this, I do, Julius, want your comments as, maybe I've missed some things that you could point out as well. But
you're doing great so far. I mean, for me, it's really great to see another market participant, market professional like you using RRG. And I'm amazed at, other people using the tool in a great way, sometimes even in ways that I haven't thought about, but, perfectly.
Well, here's the next move. So here was the decline right here. This is when the market got fearful, end of April, all the way throughout May. We bottomed at the end of May, right? So now we've got the 19 trading days, essentially, is how long this downtrend lasted. And again, you got a little garbled mess here. But if you pull them out one at a time and you sort it by percentage, there's your renewable energy. There's specialized consumer services. Now defense is picking up. Restaurants and bars Waste and disposal services. On a relative basis, these are groups not really associated with China, not getting hit.
You know what's interesting, Tom? Look at the tail that you have there. Remember what I said about velocity?
Yes.
About all these little dots that are so close together. That means that relative trend was very stable until 3 days. So we're looking at a chart that ends May 30 right now.
Yep.
So like 3 days before, so this chart started rolling over before the market bottom is in place. So this, so I think that's very, very crucial here. You see these, very low velocity is doing very well, and then it starts to roll over before the market bottoms.
Yep. And then you look at the ones that are related to China, ones that can be hit by China. And you look, there it is, heavy construction, industrial machinery, apparel retailers, or actually it's clothing and accessories, apparel retailers and computer hardware. Same groups getting hammered. So when the market starts turning fearful and you get into these trade war discussions, that is what one of the things you need to be focusing on is staying away from those stocks. Those are the ones that are getting hit the hardest. Then we go into this last, and I'm going to go right through today, which is August 15th. And then I'm going to drag this back to right at the top, which gives me basically the last, 14 trading days, 2 or 3 weeks. And again, you've got this whole mess in the middle, but I'm going to sort it by percentage change. And we're going to look at it relative to the S&P again. And here you go. Renewable energy. Yes, it's been weakening, but it's way on the right side of the chart. Tremendous relative strength. Defense, restaurants and bars, waste and disposal services, specialized consumer services.
That's one is nice.
Yeah, I mean, isn't this pretty amazing that through these 3 separate periods, the market is doing the exact same thing? You want to avoid, and I know the temptation is these stocks get hit hard, they're value plays. They're not value plays as long as this trade war continues. I think these are groups that you want. When the trade deal is struck, I think we got a completely different animal. But as long as the market's fearful, I think these are the groups, and look at them, the same ones again, just absolutely falling apart during this recent weakness. So what do you
still are? Yeah,
still are.
It's the market seems to be repeating itself, which is basically the bread and butter of our trade of technical analysis, that we rely on markets to behave like they did in the past, maybe not in a one-on-one fashion, but at least to some degree. And this is a great example. I showed the sectors, doing that similar rotation, going into weak periods. You see the defensive, and you just zoomed in on a number of these industry groups, relating it to the trade wars. But quite frankly, we now all focus on these trade wars and the discussion and the tariffs and everything that comes with it. But in the end of the day, the market is just dissecting and working its way through the news and interpreting it, and answering us by buying and selling. All the other investors and ourselves are pretty much giving that answer by their actions, by buying and selling. Because you can talk about trade wars all you want, but talking about trade wars is not going to, create any market movement. Markets only move when something happens, when people get out of their chairs or actually on their keyboards and punch in orders. I remember many years ago when I did a lot of presentations for the bank that I was working with for retail investors and trying to explain to them why markets went up or down. I always played a game, and I said, okay, so we are the market. This room here with 100 people in it, we are the market. And the Bundesbank in Germany just lowered. I'm a market maker. So we're trading one index, and I am 100 bid 101 offer. Anyone want a deal? Of course, nobody wanted to deal. And then I said, okay, so just like the real market, news is coming in from the outside, and the Bundesbank has just lowered the interest rates with 50 basis points. What's going to happen with the price? And then people said, oh, it's going to go up. And I said, all right, I am now 95 bid, 96 offer. Anyone want a deal? Nobody wanted to deal. I said, okay, now I'm 90 bid, 92 offer. I said, you said the price was going up, but nothing is going to happen. Just to explain to them that they have to get out of the chair and buy it from me to drive that market higher.
Mm-hmm. Yeah. To me, and I just want to summarize because we're going to move on to the 10 and 10, but this segment to me is really like technical analysis 101. I know some people just look at price support, price resistance, but it's more than that. It's understanding what drives the market, the fears that are in the market. I mean, sometimes it's an interest rate thing. So you need to know which areas of the market are most impacted by interest rate fears or cuts or, increases, whatever it is. Right now, we're living in a market that the trade war is up there. I don't know. Again, you can say it's the biggest news of the day. Maybe it's second or third. It's pretty big. Mm-hmm. And if nothing else, I think when you look at these charts that Julius and I just showed you, I think it clearly shows that when the market gets into one of its funks, you really want to make sure and pay attention to where you are and what stocks you own. You don't want to be in these areas of the market that are just getting tossed to the side. But it is time for the 10 and 10. And Julius, I don't know did you have time by chance to put the 10 and 10 in a RRG?
I am awaiting my codes, and as soon as I have them, I will bring them up in an RRG.
All right, I tell you what I'll do. They're actually in there. You can go grab them. But I'll go ahead and start with the first stock, which is Procter & Gamble.
Yeah. Sorry, guys.
After I do the first one, why don't you bring up the RRG? I'd really like to see how you take a look. We'll have a minute or so. You can take a look at those for everybody. All right, I'm going to go ahead and jump in here to Procter & Gamble. This is the first 10 and 10 stock. I'll be honest, I like this chart a lot. It's in the consumer staples area, but it's okay to own consumer staples, especially when you've got relative strength like Procter & Gamble is showing. It's breaking out versus the S&P 500. If my number one goal is to outperform the S&P 500 and we're in a fearful market, well, sometimes consumer staples and defensive areas aren't a bad place to turn. I think Procter & Gamble looks really good. Great earnings report at the end of July, had that huge gap up, went back. Yeah, actually even filled the gap, went a little bit below, but I think holding on to key short-term support. I would look for Procter & Gamble just to trade in a trading range here. But to me, it's a way to be involved in the market, but maybe in a lesser volatile stock. So not for everybody. I mean, if you're trying to catch the bottom of this move in the market and you want to soar back to the upside, Procter & Gamble is probably not your best bet. But if risk is more of a concern for you, then I think Procter & Gamble is a really good looking chart.
I got the RRG. Do you want me to grab the screen and show that, and then you take it back? Yeah.
Yeah.
Okay.
For a minute. Go ahead and take it, and I want to
take the screen here. Yeah, no worries. So here's your RRG with the 10 and 10s, and your you talked about Procter & Gamble. I mean, it moves from leading to weakening, but look at this velocity, very low velocity. So this means that it is a stable relative trend. It's on the right hand side. It's rolling over a little bit, but I'm not too concerned about this. It's when these velocity picks up, I'm concerned, but not right now.
Okay.
And then let me quickly go over. So GE looks very good. AGRD still good, but losing momentum. Starbucks, never sell Starbucks. It turned around and moved into the leading. We've talked about that the previous time I was on the show. Spiders Retail looking really good from a relative point of view. Workday really good. All the chance to roll back up. PG we just talked about. Twilio starting to curl up, but it needs to act very, very quickly. PepsiCo, very low velocity, so that's pretty cool. Yeah, this one, I'm very curious what you're going to say. I haven't seen the chart, but this doesn't look very good to me. And Dunkin' Brands is inside lagging, low velocity, which means that it is a stable relative downtrend. So I don't expect much from this chart.
I'm really surprised, actually, Julius, that GE looks good on the RRG. I mean, GE just got hammered today.
Yeah, it's the longer one. Oh, sorry. Yeah, this is the daily. But if you look at the weekly, I'll just quickly do that. And you'll. Where is GE here? There you are.
Yeah.
So that was a little hiccup for GE.
Yeah, it's down 11 or 12, 11, almost 12% today. So let me go ahead and annotate that, and we'll get on through the rest of the 10 and 10. Try and get through here quickly. Yeah, GE. The problem here is the huge gap.
Oh, Tom.
Yes.
My Yeah, that was bad. My bad. The slider was at that time. It was somewhere in April when
Oh, okay.
he was very up. So forget about that. That was a mix-up.
Okay. Yeah, I had a feeling that
Yeah, it was not up to date. Sorry about that.
That's all right. No problem. All right. So GE, you can see here on the screen. I mean, just a huge gap down. Look at all the volume coming in before this. That's also something I watch closely. It's like if I'm coming back down just to test support and go back up, usually it's on light volume. This was not light volume. GE was getting hit pretty hard to the downside on increasing volume. And then, of course, we had the big gap down today. So I'm not a fan of GE. I think this breakdown on heavy volume is a sign of probably more selling to come. So I would avoid it. All right. What do we got on the next one? Do you have those, Julius?
Yeah. AJRD.
AJRD. All right. Nice gap up with, I'm assuming that probably was earnings back here. Really nice gap up and continuing to perform really well on a relative basis. So this is one that I like. I think if you hold on to that recent low right there, I mean, I suppose maybe we could fill all the way back. I don't think we will. I think maybe you'll see that $46 level tested. And if so, I actually would be a buyer. I like it. I like AJRD.
Next one is ARQL. By the way, AJRD nicely in the leading quadrant.
Oh, cool. I'm sorry. What was the next one?
ARQL or QL.
Yeah, that was the one you didn't like. Well, of course, that was a while ago. So maybe
but I still don't like it. It's the worst one in the universe that's on the screen right now. By the way, I'm going to share this in the write-up so people have the right RRG to look at.
Yeah, I think, part of this on a short-term basis, clearly ARQL is not good. I bet on the weekly chart, it looks better because it was in a nice uptrend for a while, and it's just been the last 30 to 45 days where it's pulled back. But I'm going to say that you've got some really good support coming in here around $8. We almost got there a little over a week ago. I think we could head back down there, but there was a lot of buying that took place around $8. So even if it looks bad on the RRG, I actually like this one as it gets closer to $8.
Okay. Next one is Dunkin' Brands, DNKN.
All right, it's in a good space, that's for sure. We talked about the restaurants group earlier, and look at what it's doing. You wouldn't know that there is a trade war and S&P 500 dropping like it has if you just looked at this chart. And that's because, number one, you've got a great group. Dunkin' hasn't even been one of the better stocks. In fact, it's been one of the worst stocks in the space. But it's outperforming the S&P by a mile because it's in a great area. So a lot of money rotating in. It's almost like having maybe the cheapest house in the neighborhood. If everybody else's house is going up, so is yours. And Dunkin' Brands is benefiting from that. I think we got a little overhead resistance that we're testing right now. If we can break out, that would be great. I like other restaurants better, but if I was, looking at this versus, say, the Spider, I would jump in on this. I think Dunkin' Brands looks good. Again, Starbucks, Chipotle, some of the others I think look better.
Cool. GE we just did. Next one up is PEP, PepsiCo.
All right, it's in that soft drink area. I actually like Coke, I think, better, not just for taste, but also on the charts. I probably gave more information than anybody really wanted. But anyway, Pepsi is definitely improving. It's gotten back above the 20, which I think is a good start. I wouldn't want to see it roll back over. And I'm going to be honest, the support level I want to watch now is right there. That's where we had to gap up. We've been testing it, holding. I'm going to say 124. I'd watch that and keep that as a stop level if I was in Pepsi.
Next one up, PG, Procter & Gamble.
That was the first one.
That was the first one, sorry. Then we go to your favorite place, man, Starbucks.
I typed in the symbol before you even said it. I knew where we were going. Now, this one is in the restaurant group, and it's one of the best stocks. So I just mentioned Starbucks. I love the stock. I think that this is, and I love their lattes. Don't need to get into all that. But I think if there is weakness on the stock, you'll probably see a lot of buyers coming into the stock between 90 and 92. I like it. I don't it.
Very good. And then we go to TWLO, Twilio.
All right, got a few more. I'm going to zip through these. Twilio. This one I'm starting to have some problems. There's that volume picking up, and the failure at the 20-day. Let me draw this support line. I don't know if we've already gone below it or if we're just testing it, but we have had a lot of tests around that 120 to 125 area, and we're in that zone. And the only other thing I'll mention here is that so far we are failing at the 20-day. So
way inside the lagging quadrant as well.
Yeah, so this one's starting to deteriorate. I'd be careful with it.
And the last one, WDAY, workday, WeDay.
WDAY, I think we got one more. I think there was XRT in there.
Oh, sorry. Yeah, you're right. I thought it was a benchmark. Yeah, you're absolutely right.
No problem. Let's go ahead and pull this one up. This is another one, just like Twilio. I think that you got to keep a really close eye on. I mean, we're moving to 4-month low, heavy volume, trending below that 20-day. Relative strength is now down at about a 7 or 8 month low. This was a great looking stock for a while. Not so much anymore. I would look for something else in the software space personally.
Exactly.
And then XRT.
Yeah, and then XRT.
All right, let me get that one up here quickly. And XRT, yeah, breaking down. I mean, couldn't have had any better news for retailers today, to be honest. I mean, retail numbers were blown right out of the park, and yet we are down and we've lost support. I follow the charts, not the fundamental news. I don't like what's going on here with retail, and I'd stay away from it. And that is the 10 in 10 that we can bring up on your screen, give you a summary. And yeah, we got a couple minutes here to wrap up the show, Julius, but yeah, good show, very good show.
Yeah, I was thinking about, because I'm back tomorrow, one of the things, because we've been talking about trade wars, and this week it's all about yield curve.
Yes.
So I think we should pay some attention to the yield curve tomorrow, and I will. Well, I don't really have to prepare that because I can talk about that very easily, about how you can use RRG to analyze the yield curve and analyze fixed income moves. Because most of the people use RRG for stocks and sectors, etc. But there's actually a lot more that you can do with RRG. So I'd like to spend a little bit of time tomorrow in the show showing how I use it for analyzing yield curve movements. What about that?
I think that's great. I think what we need to do is tie it in, the yield curve inversion with RRG, and also what's hot, what's not, because I think we can also bring it all together. So that would be a fun segment. Before we go, I do also want to mention, take a minute to announce the StockCharts.com's president, Chip Anderson, will be rolling out a new show on Saturdays, and it's starting this Saturday. All aboard StockCharts. Chip's going to show you all the best ways to use the new ACP charts, all the great tools here at StockCharts.com. It's going to air for 1 hour every Saturday, starting this Saturday at 1 p.m. Eastern Standard Time, and there will be replays. So if you can't make it at 1 o'clock, it'll be replayed on the StockCharts channel. It'll be posted almost immediately over to YouTube. So you have a lot of different ways to check that out. But if you're a StockCharts subscriber or you're thinking about becoming one, that is going to be a must-watch show every week to make sure you're getting the most out of your subscription at StockCharts. So again, starting this Saturday, August 17th, 1 p.m. Eastern, make sure you join Chip. All right, Julius, it has been a great show. Just want to point out to everybody that just to update, we do have the Dow up 65 points. Bad news is I'm seeing defensive stocks leading to the upside. I don't think this move to the downside is quite over. But looking forward to doing another show with you again tomorrow, Julius. Want to thank everybody out there for joining us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. And Julius and I will see you back here tomorrow.
See you tomorrow, Tom.